error at the top there that says 2 p.m. on the Zoom virtual meeting notice. Everything else says 3 o'clock, but I think that one got missed there at the top. But it was kind of pointed out earlier. I just wanted to mention that, but it's all yours.
Okay, thank you. So I'd like to call this meeting to order of the joint quarterly meeting for the 3 pension boards. Can we get a roll call for each of the boards?
Nick Curry.
Here.
Georgette Dumont.
Here.
Christine Hoffman.
Here.
Brandon Maresma.
Here.
Eddie Vergara.
Here.
David Cohill.
Here.
Marvin Dupree.
Here.
John Gallarno. John Gostilla.
I'm here.
Jason Sharp.
Here.
Gaylord Candler.
Here.
Ed Dawson. John McDaniel.
I think let's pause on Ed Dawson there. He's on mute. He might have thought that I can see him here, but well, he's not unmuting. I'm gonna ask to unmute him.
I'm actually seeing him on here twice.
Yeah. I actually heard him earlier when he first joined. Hey, there you came off mute. So
Ed Dawson, are you here? Okay, we'll go back, I guess. Dennis Pavlovsky and Debbie White. Wasn't Debbie on earlier?
yeah,
She was. Okay, so as of this time, we do not have a quorum for the firefighter board.
that's true.
Okay.
Debbie was definitely on here.
Yeah, she was.
All right, let's see if we can round up some firefighter boards so we can take some votes. Okay, next up, do we have any visitors who would like to take advantage of courtesy of the floor? I'm not seeing any participants. Do we have anybody? Dustin? No?
No, I don't believe so.
Okay. Old business, we have our minutes to be approved. You should have the minutes of our June meeting in front of you. Can I get a motion for approval?
Motion to approve.
I think that was Ms. Dumont. Is there a second?
Second, George Candler.
Mr. Candler, I think we can do all in favor. Aye.
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 Any opposed to the minutes? I guess I didn't give time for discussion. Sounds like we're good. Motion carries, minutes are approved. New business for the General Employees Board, we have an application for retirement from and a recommendation to approve the retirement of Betty Lucas, Police Records Supervisor, backdrop retirement effective 10/1/2017, separation date 6/17/2020, meets age and service requirements for backdrop service retirement, 22 years, 2 months of service. Can I get a motion from the General Employees Board?
Motion to approve.
Is there a second?
Second.
I think that was a motion by Dumont, second by Curry. Is there any discussion?
I just want to note that Betsy has just done a fabulous job. When I was volunteering with the police department, I was in the records department for, I guess, maybe a couple of years, maybe more, a little less. I don't recall. It's just kind of a big old time splotch. but she really did a great job, and this is a well-earned retirement for her. So I hope she enjoys it. She can do everything that she's dreamed of doing while working, but couldn't because she was working, and I wish her all the best.
Thank you. Any other comment or discussion? Okay, roll call vote for the General Employees Board.
Nick Curry,
Yes.
Georgette Dumont,
Yes.
Chris Hoffman,
Yes.
Brenda Maresma,
Yes.
Eddie Vergara.
Yes.
Okay, I think that's it there. Now we have our consultant report from Brendan Vavrica of Endco Consulting. Take it away, Brendan.
Good afternoon, everyone. Dustin, do you want to page through, or would you like me to drive? You got it?
Well, this is, hey, if you would like, I know there's more than just the normal, so if you want to drive, that's fine, but Jacob, you may have to assist with how, for him to be able to do that, because right now we're sharing from my
Okay.
agenda package.
Sorry. Yeah. Okay.
and
Let's just go off of there. I was planning to stick with that anyway.
Hey,
So that's
Okay.
Brendan, I'm sorry, before you get started,
Sure.
it appears that we have Ed Dawson and Debbie White on the line, and I noticed that because they also appear to not be muted. Ed, are you there? Ed? Okay. Can someone mute Ed? Dustin, do you have that power?
I muted him.
Thank you. Oh,
Okay.
the voice from beyond. Thank you, Jacob. It looks like Debbie's connecting. So, okay, Brendan, go ahead, and sorry to interrupt.
okay. Well, obviously, the last time we got together, the report that you were looking at was very negative. Obviously, all the negative information related to COVID and shutdowns was kind of realized in that February and March period. But what had already begun was some of the recovery. The Fed had taken a number of actions. The federal government had come out with some stimulus. And so things were starting to rebound. And here we are looking at the June 30th report, and really that trend continued through the full length of the quarter. So not really a whole lot changed from what we discussed last time, other than some minor things, some positive news related to some potential vaccines or other therapies related to the virus. And obviously some additional ongoing, reopening of certain parts of the economy in different places. So generally speaking, that sort of positive, backdrop, continued. So ultimately, we wound up having a very good quarter on the heels of what, of course, was a very, very difficult quarter previously. But as you see here in the upper right-hand corner of page 1, for the period, for the month, or excuse me, the quarter ended June 30th, international stocks rebounded very nicely. They were up somewhere between about 15% and 18% for the emerging markets. But our domestic stocks did even better. The S&P 500, our large caps were up about 20.5%. Small caps were up 25%. And then the last piece was the fixed income was also positive, up about 2.9%. So typically, when you have equities this positive, you'll have fixed income be negative. But in this particular quarter, obviously, the fixed income was positive. So really, all of the major asset classes that you're invested in did well in absolute terms. When you look down in the bottom right-hand corner, you can see the last 12 months is a bit more of a mixed bag. So certainly the international stocks in red and pink, as well as in the domestic stock section, the bottom two, the Russell 2000 and the Russell Midcap, were negative. So despite the good quarter, they were still overall negative over the prior 12 months. Yet the S&P 500, the large cap stocks, were up about 7.5%, and the Barclays, or the fixed income, was up about 8.7%. So again, over the last 12 months, you can certainly see the divergence between certain parts of the stock market and when the bond market doing well, while other parts didn't do quite so well. If we flip to the next page, just something that, again, I've mentioned many times, but want to highlight again, because we continue to see the difference between the performance and the growth part of the market versus the performance and the value part. It doesn't matter, large cap, mid cap, small cap, it's the same trend. The growth index was up somewhere 28 to 30% in the quarter. while our value stocks were up somewhere between 14 and about 19%. And if you look down in the bottom right-hand corner over the last 12 months, you can really see that difference. It's pretty incredible, where you're looking at, for the large cap or the 1,000 growth index up 23, yet the value is -9. That is a significant difference and not one that you would typically see. And when we get to the plan assets, of course, you'll understand why our Wells large cap growth portfolio is significantly larger than the other pieces of the pie, because again, those growth company stocks have been performing much better than certainly the rest of the market. If you flip to the next page, I believe we get into just a quick fixed income review. Down in the bottom right-hand corner is where I spend most of the time typically. And what you'll notice, obviously, from the 12/31 quarter, which is the red line, we had a significant drop in interest rates last quarter. This quarter, it was relatively subdued, some minor adjustments going from that orange to the green line. But in the grand scheme of things, the fixed income markets were relatively stable, with one noticeable difference. If you go to the upper right-hand corner in the chart, look at that sort of light blue bar or light blue line, which represents the option adjusted spread of a lower rated but still a investment grade corporate bond. And what you'll notice is back in February and March, that the difference between the spread over a treasury widened dramatically. And if you might recall, we referenced Sawgrass underperforming a little bit. And that's because they own some corporate bonds in the portfolio, as most active managers do. But last quarter, corporate bonds and anything except treasuries did very poorly. And that's what you see, the spread on those securities widen very dramatically. What I wanted to highlight here is in the current quarter, from March now to June 30th, you saw a significant decline in that spread. It's not quite a full recovery, but it's a pretty significant one. So we saw the markets kind of continue to normalize, and those spreads came back to a much closer to normal range, which again is somewhat evident when we see the general numbers. But again, it'll be somewhat indicative of the Sawgrass performance when we get there in a minute. So with that, I'll just sort of stop and see if there are any questions based on general market moves or any of the interest rate or index discussion before I move on.
Well, since you mentioned it, Brendan, just for my own edification, I did a quick Google search on U.S. GDP change over the second quarter 2020, and it's down over 30%, and yet the market rebounded. Not that the two necessarily have to be linked, but boy, on the long term, you wouldn't expect that to last very long.
Correct. Yeah. What you have to, what the market is, in my opinion, at least, looking forward, kind of beyond. Obviously, the market was down some 30 some odd percent in the first quarter of the year in anticipation of that terrible GDP, because everything was shut down and the like. And now the market, now that we're reopening and there's at least some optimistic news related to some treatments, obviously nothing's happened yet officially, but we seem to be headed in that direction. The market is trying to discount some of that information and look to the future, where hopefully things continue to get better and improve. But certainly, yes, that is a historic drop in GDP in a very short time. And I think we just heard a couple of days ago that the UK announced it was their worst GDP decline ever on record. These are obviously sort of historic levels, but really the question becomes: is it a longer term issue, or is it just a speed bump that we hit and then we get past the virus and kind of get back to a more normal economic situation? But obviously only time will tell. So if we move to the next page, page number 4 here, this is your graph that charts your asset history against that, your investment assumption rate. And what you'll notice or recall from last time is we had actually dipped below that red line, but obviously we have snapped back quite nicely. So as of the 30th of June, you're up over $96.7 million, well ahead of the theoretical line, which was just over $90 million. By way of an update, the markets have continued to be positive here in July and the first part of August. So as of this morning, the assets of the plan were just short of $101 million, actually $100,932,000. So as we sit today, you're actually quite a bit better than even we're seeing on this chart. But obviously, just this chart by itself is looking very good, and it's certainly nice to see it kind of bounce back after having touched that red line there for a brief time. On the next page, we look at the actual asset allocation. And this is relative to our broad targets. And so what you'll notice as of June 30th, not surprisingly, our equity investments are a little above target because they were up, 15, 20% in the quarter. And our fixed income was below target because, although positive, was not up near the same amount that equities were. And then real estate and cash are essentially right there on the flat line. I mentioned that the assets continue to grow in the plan. And so that overweight or underweight with equities and fixed income has widened slightly. So as of today, it's roughly a collective 3.5%. So if you add the underweight in domestic fixed income and you add the underweight with the global fixed income, you add the two together, and it's about 3.5% in total that we're overweight equity relative to fixed income. And again, that's just because of the continued performance of your equity portfolio versus that of the fixed income portfolio. The short version is it's still very much in line with the policy, but we'll kind of touch on any potential rebalancing in a few minutes. As we move ahead to the next page, this again is just a summary of all of the activity that took place in the quarter. You can obviously see the rebalance action from last time, taking a little bit of money out of equity and the like. But it shows at the end of the quarter, the beginning of the quarter, we're at about 85.5 million, and then we ended the quarter at that 96.7 million. Obviously, the majority of that is the appreciation of the actual investment portfolio, which obviously is nice to see given the losses that we saw the prior quarter. The next page, I believe, gets into the actual performance and numbers. And the reality was you guys had a great quarter. So you're up 13.97% versus the policy, which is up 13.16. You placed in the 53rd percentile amongst the public fund peer group. Arguably, the most important number on the page is that second column in the fiscal year to date. So it's standing at 4.4%, 4.38 versus that 6.1. So there is a deficit relative to the policy. But the good news is, 4.4 is a relatively decent number, at least compared to where we were sitting 3 months ago. That number was very negative, and obviously was a little troubling given the 7 3/4 assumed rate. But obviously the market rebounded quite nicely. So we're sitting there at that, let's just call it 4.4. And then I mentioned that as of today, the assets are approaching 101 million. On a market value basis, that is a return of 4.3%. So again, that's not a perfect calculation, but when you add that 4.3 to that return you already had through June 30th, we're sitting at a roughly 8.7% fiscal year to date return with, call it, 6 weeks to go. So obviously things have turned very nicely here in the last 4 to 5 months. And now we're in a very good position on the fiscal year. If the markets can cooperate for another 6 weeks to sort of get us there to September 30th. Certainly very nice to see considering, where we were back in February or March. If you look out over the longer term for the total fund, again, you continue to see very high universe percentiles. The 12th percentile for 3 years, 20th for 5, 23 over 7 years. We're ranking certainly in the top portions of the public fund universe. And I'll call decent absolute returns in the 7 and change, and then over 10 years, approaching 8.8%. So again, very, very good performance. As we move down the page, you can see, where the performance came from. I'll skip over, Vanguard, they're the index fund. They did exactly how they're supposed to. Wells, your large cap growth manager, had a very good quarter. They were up about 30.6% versus their benchmark of 27.8. Although for the fiscal year or the 1 year period, you will notice the performance deficit, and that's one of the factors as to why the total plan was under for that fiscal year to date period. But again, a nice rebound there, and certainly the best performing piece of the portfolio. JP Morgan, our large cap value manager, did 13.3 versus 14.3, which is not all that surprising. If you recall, a short time ago, when we made the switch over to JP Morgan, they tend to be a little bit more conservatively positioned. So when the market's screaming higher, they'll tend to lag behind. But you'll notice over the last 12 months, they've outperformed pretty significantly over that negative period. So overall, still doing very, very well. And then we have the Eaton Vance Atlanta SMID Cap, a little behind for the quarter, 22.3 versus 26. Although for the longer term, whether you get out to 3, 5, 7 years, that has been a very good portfolio in terms of relative outperformance quite significantly on an annualized basis. But again, just stumbling here this recent quarter. If you flip over to the next page, page 9, we get into the remainder of our equity assets in international. And the story is very good here. Euro Pacific was up 22.7 versus 16 for the benchmark. And for the year, 3.1 versus negative 4.4. So fantastic relative performance. And really the same story with WCM, up 25.7 versus 16. And for the year, up almost 14% versus that same negative 4.4 for the benchmark. So really fantastic relative performance out of both of your international equity managers. Then we leave that and we go to fixed income, Sawgrass, which I kind of referenced earlier. As you recall, they were underwater a little bit or underperformed last time. We saw a very nice rebound. So they were 3.2% versus the benchmark of 1.6. And now for the last 12 months, they're outperforming 9.4% versus about 9.1. So very nice to see that rebound again as the corporate bond market kind of more normalized. It certainly helped their portfolio and bring that back. As a reminder, they're a very high quality manager, but in the prior quarter, it didn't matter. You could be AAA or AA rated corporate. You were sold because everything other than treasuries was sold. The last fixed income piece is the Templeton Global Bond. I'm going to go over this very quickly because the trend is still there. The poor performance, we've talked about this at length. And actually, I have some additional information to discuss with you related to this fund, but did again just sort of want to highlight that the fact that it has continued to underperform in the most recent period. And then the last piece of the fund is our real estate portfolio with JP Morgan. What you'll notice actually for the first time in 11 years, real estate has been negative for what I call the private type real estate portfolios. It has been positive for 11 straight years, but obviously with the impacts of the COVID virus, certainly on retailers and in the office space in particular, we're starting to see impacts to the real estate market. And obviously they had some negative performance there. So they were down 2.02% versus the benchmark that was down 1.3. And now for the last 12 months, it's about 2.25 versus about 2.5. One thing I will say, that when it comes to real estate, they do have some discretion about how they account for certain parts of their portfolio. And I was speaking with JP Morgan just a few short weeks ago, and they've been very aggressive in writing off any uncollected rent. So just as if they own a public strip mall and a lot of businesses were shut down and some of those businesses didn't pay their rents over the last few months, JP Morgan just went ahead and wrote it off as if they weren't going to collect anything, where some of the competitors are keeping it as deferred rent. They didn't collect the rent, but they're keeping it as a receivable. So it's not hitting their performance. So that's one of the reasons why JP Morgan's performance looks a bit worse this quarter, is because they went ahead and just said, we're going to assume we're not going to collect any of that rent, and wrote it all off. Now, going forward, if those businesses come back online and pay back that rent, then of course it becomes an addition to the portfolio and a boost to performance later, as opposed to some deferred future write down if it doesn't get paid. So I did just kind of want to mention that that's one of the reasons that portfolio underperformed, is because they were very aggressive in writing down some of those problem areas when it came to rent collections this time. But hopefully that will kind of set the stage for better performance as we move forward. The other thing I wanted to mention, with the real estate portfolio, that's not something that's traded like a stock or a bond. And these portfolios, if you want to take back some or all of your investment, you put in a request. And in periods of high volume, they put in what's called a queue, or essentially a waiting line. And that particular portfolio, just to update you, now has an exit queue of approximately $2.9 billion, which is roughly 8% or 9% of the fund. They're anticipating that they will have that, paid off, so to speak, or they will work through that queue by about next summer. But just kind of wanted to give you an idea of some of the dislocation in the market and what that's doing to the funds. Obviously, if you want all of your money back and they don't have the cash, they can't just go sell an office building in a day to raise that money. That's why they institute those queues to kind of prevent any short-term, forced transactions. So again, just wanted to provide a little context there. Yes, I'm sorry?
Yeah, so Brendan, it sounds like a lot of these funds are trying to lock in their losses.
Yeah, well, I'm hopeful that that's not the reason they're doing it. One of the things that we saw, especially in the first quarter, when equities were down 20 or 30% and your real estate portfolio was not written down, on paper, that real estate portfolio became a much larger piece of the pie. And so many, investment policies required certain clients to say, okay, well, we need to redeem some of those real estate assets to rebalance back to equity or other pieces of the portfolio. And actually, we saw this a lot back in 2008 as well, because you had the same dynamic where equity sold off first, and then the write-downs in real estate, took a few more quarters to be realized. So there were a lot of redemption requests in the real estate portfolios. But then what happened back in 2008 into 2009, and also with the rebound that we've had here in the last few quarters, is a lot of those outsized positions or weights have sort of corrected themselves. And so what the managers, and it's not just JP Morgan, but some of the other real estate managers as well, have been saying, we have all these redemption requests, but we're starting to get them canceled, or at least canceling part of them, if not all, because as the plans have their next meeting or their next report, they're realizing that their other assets are rebounding and they no longer are out of bounds with their investment policy or no longer need to rebalance. So that's one sort of the positive aspect is those redemptions are reduced. But at the same time, if you wanted some of that money today, you'd have to wait a while because, again, there is still that queue in place. And again, I'm not suggesting anything like that for you, but I just kind of wanted to give you a little bit of context to the market and what's happening in that particular portfolio. I believe that's the last page of the actual performance. Obviously, we have a reminder of your fee schedule, and you can see operating the full plan with all the active management that you have. You're operating at about 45 basis points, which we feel is a very good fee given your plan and your size and the number of different portfolios that you have in the mix. So with that, I'll stop, see if there's any questions on anything in the actual report, anything else that I can address for you before we kind of dive further into a Templeton conversation.
I'll maybe just put in a word as the skeptic, let's say. And I've mentioned over the last couple of years that, and a lot of us are probably reading a lot of stuff about how pension funds are not as healthy as they should be. And, which is what motivates my skepticism or wanting to ask questions. And the 10-year figures look great, but it's worth keeping in mind that when the market has a bit of a drop, we look at it and say, well, we're doing pretty good. It was just this drop is what caused it. Whereas the reason that we're looking good after 10 years was because 10 years ago today was right pretty much at the bottom of that last recession. So So those 10-year figures don't look quite as good as they otherwise would.
Yeah, those numbers are very what we call endpoint sensitive.
Yeah.
And you're absolutely right. It was just a few quarters back in March where you were, or March of last year, where that 10-year period lined up exactly with the lows back in 2009. So those 10-year numbers were even better then. They've actually been kind of coming down a little bit as we've moved away from that. But yeah, it's a very good point that, it can be very deceiving when you look at those numbers and think, wow, it was very easy the whole time, or you've had this annualized performance obviously that looks good, but of course it has its ups and downs along the way. And then the question becomes, yes, we earned that 8.7% over the last 10 years. What about the next 10 years? And that's some of the discussion with capital market assumptions. Certainly, interest rates have been falling dramatically, and they're at historic lows. So with a portfolio that's targeting 35% fixed income, if we're now expecting a go forward rate of return of say 1 to 2%, if you're lucky, it becomes a lot harder, because over the last 10 years you've been earning 5, 6, 7% out of those funds. So that's some of the ongoing kind of asset allocation discussion that we're always having and looking at the portfolio.
Yeah, that's the really low fixed income returns are something that we've talked a lot about as well. And if you hear anything about rethinking it, given that interest rates are so low, by all means, please share it with us if it comes up.
Sure, of course.
I'll also add that that apparent contradiction between the market, the economy collapsing or dropping significantly, and the market recovering then is based, as you pointed out, and I didn't think of this, was, it's expectations. But so needless to say, if those expectations aren't borne out, if we don't have a V-shaped recovery and, for a quarter or two, we continue without much in the way of a recovery, those, so-called animal spirits may start to run for the exits.
Sure. Yeah, that's definitely a concern, especially anytime the market runs the way it does. You question how much good news is baked into those numbers, and then of course if anything changes, obviously that could have a pretty negative impact. So far, the one thing I should say that we certainly have going for us is the Fed. There's kind of a common statement out there: you don't fight the Fed. And for the last 4 months, the Fed has been incredibly active in different programs, whether it's bond buying programs, liquidity programs, and then just coming out and saying they're going to continue to do what they need to do to keep the market and the economy moving. And so I think that's another reason why markets, particularly the equity side, are looking favorably. They say, if we run into any more problems, if something happens on the downside, the Fed is going to step in and take action to make sure it doesn't derail the recovery. Again, that's only time will tell if that truly holds, but I think there's something to be said for that optimism that the market has, saying we're on our way to recovery, and we've got this Fed here that's saying they will be a backstop for us if we hit another speed bump.
Great. Any other questions? Okay, thank you, Brendan. For that report, I think we'll go ahead and do the approval vote before we move on to the global fixed income discussion.
Okay.
And I believe we still do not have a quorum for the firefighter board. Someone correct me if I'm wrong.
I think we may. Dennis has joined the meeting, and Debbie is here. It said connecting to audio, so if she could just test out her audio, maybe we
We'll go
might
ahead
have a quorum.
and do other boards while we're waiting for her. Dennis, thank you for coming down from the mountains with that facial hair for us. Okay, so let's get a motion from the General Employee Board to approve the June 30, 2020 quarterly investment performance report.
Motion to approve the June 30, 2020 investment report.
Motion by Demont. Who was that second? Sorry.
Cohill.
Second by Cohill. Any discussion?
Cohill, you're not on the general.
Oh, yeah.
No, missed that part, sorry.
Good
No
call.
problem. You're just getting ahead of the game.
I was doing it by board because I never remember which is which, and just in case the firefighters don't have a quorum. Can I get a second from the general employee board member?
Second, this is from Brandon.
Thank you, Brandon. Any discussion? Roll call?
Nick Curry,
Nick, you're muted.
It's on your phone.
Nick, give us, can we take a thumbs up vote or? There we
you
go.
There you go.
Can you hear me?
Yep,
yes.
There you are.
say yes. Okay.
Yes.
Georgette Dumont,
Yes.
Christine Hoffman,
Yeah.
Brandon Maresma,
Yes.
and Eddie Vergara.
Yes.
Okay, police employees board, same motion.
Motion, Cohill. Second, Sharp.
Any discussion? Roll call?
David Cohill.
Yep.
Marvin Dupree,
Yes.
John Gastilla,
Yes.
Jason Sharp.
Yes.
All right, let's see how the firefighter board goes. Can I get a motion to approve the June 30th quarterly investment performance report?
So moved from Candler.
A second from Poplawski.
Any discussion? Roll call?
Gaylord Candler,
Yes.
Ed Dawson. Oh, sorry. What happened to him? He's gone? Okay.
He's not in the meeting anymore.
Okay. Dennis Pavlovsky
Yes.
and Debbie White.
Debbie, you there?
I don't know. I sent a request to unmute to her and she unmuted, but I don't know. Maybe she's using I don't know. I think maybe she's using a computer that doesn't have a microphone or something.
Yeah, her mic might not be working. Can we accept a, oh, we don't have the
I don't have visual either.
options either, do we? Like a raised hand, if she accepts, can we accept a raised hand in the participants view?
I have to defer to Jacob on that one. I don't know the
That,
ins and
that
outs of-
functionality is on. That would be not my call on whether you can accept that. or not.
Chris in the building.
Hey, Debbie, if you can hear us, will you raise your hand in the participant box? Okay, let's move on. So we don't have a completed vote on the approval by the firefighter board, which I think that also may hamstring us on taking a vote on the global fixed income if we come to a consensus, but I would still like to go ahead and do that presentation and we can have discussion and hopefully between now and then we can get Debbie to join us. But so the good news is Templeton has continued to disappoint us. So this presentation is very timely. Go ahead, Brendan, take it away.
Okay, well, thank you. So it should be the next page on the, there we go, in the agenda. So obviously Templeton has been a bit of an issue. You know, you've had them for a while. They tend to be sort of a contrarian type portfolio. Where over time they've actually performed well, but it is a bit of a relative roller coaster. You'll have one quarter where the market's up 3 and they're down 5, and then you'll have another quarter where the market's down 3 and they're up 5. So that in the past had kind of worked out over time. They've been outperforming the benchmark, but the last few years it's been a bit more consistent in terms of underperformance. So that's something that's been getting some more discussion these last few meetings. So we wanted to go ahead and put together some information, some potential replacement ideas. But in addition to that, this portfolio with Templeton, they're actually going through a merger where, you know, there's some concerns starting to pop up about, you know, some of the personnel leaving. There's been some marketing folks that have left. Not that that has a direct impact on the portfolio management, but just some other things happening that, along with poor performance, is starting to concern us a bit more. So it just helps that we're already kind of here talking about it to kind of push that discussion along. So with that said, we have 3 funds that I wanted to introduce you to, in addition, obviously, to the Templeton Fund. One is the Legg Mason, sub-advised by Brandywine, called the Global Opportunities. Then there's Loomis Sales Fixed Income, and then PIMCO Diversified Income. You can see these are all mutual funds, like the Templeton Fund is, and obviously different fee rates: 59 for the Brandywine portfolio, 57 for Loomis, and a bit more expensive at 75 basis points for PIMCO. If you flip to the next page, just a little bit of background. I'm not going to go into it in great detail, but what I wanted to highlight is the very top row on this page. What you'll notice is the Brandywine, the Loomis, and the Templeton portfolio are kind of in the same ballpark in terms of the number of positions they have, somewhere between, call it 180 and about 280 positions. PIMCO is kind of the outlier here with 1,700 positions. Now, obviously, PIMCO is a very large, fixed income shop. So they have a lot more assets. So they end up buying a lot more securities just because of the sheer dollars that they're managing. So I did want to kind of highlight that for you. And then if we move to the next page, we get into some of the trailing performance. Uh-oh. We're going to lose.
It appears that it came back.
Okay.
There we go.
So just to give you a frame of reference over the last few years, we include obviously those 4 funds. So I'll go through the last 5 years as an example. On the 5-year number, Brandywine is about 2.8%, Loomis at 3.5%, PIMCO at about 5.5%. Templeton was at 56 basis points to the positive versus the benchmark of about 2.25% for the global ag, or the multiverse at about 2.4%. And just as a reminder, because these are all mutual funds, all of these returns that you're seeing are net of fees, in case you were wondering. If you go out even longer, out to the 10 years, you can see obviously that performance. Again, 4.1 for Brandywine, Loomis 5.6, PIMCO 5.9, 2.8 for Templeton versus that 2.8 for the benchmark, or the multiverse at 2.96. If you flip over to the next page, this just gives the same information, but by individual calendar year. I really just include this as a reference in case there's some discussion about sort of the volatility or the year-to-year underperformance or outperformance. But if you move on to the next page, we get into some of the risk statistics. This is the rolling graph. What this is graphing the last 10 years worth of where their 3-year performance was lying. And so obviously you can see there's different levels of that relative performance. And this is, again, performance above the benchmark. Down at the bottom, it's the ranking based on excess returns. And what you can see, kind of the green and gray lines, which are Loomis and PIMCO, tend to be the most stable near the top of the page. They tend to be the most consistent of the group. Where obviously the yellow line, Templeton, is certainly on the bottom graph. You can see it kind of zigging and zagging from top to bottom. That's the contrarian nature that I mentioned. They have a really good quarter, then a very bad quarter, then a good year or a bad year. Did we lose the graph or lose the page?
Yeah. Well, I'm not sure how to close that. Okay, there we go.
There we go. And then if you flip to the next page.
Yep. Lost it again.
Is that blank for everybody?
It's like it's an Adobe issue. Just a second here, and I'll have it back up.
Can you see me now?
Is that Debbie?
Yeah, I changed computers. Can you see me now?
We can hear you, but
yeah,
I can't see you.
I can hear you at least. That's all we need.
Okay, well, I'll vote yes on that last. I'm accepting the report when you couldn't hear me.
Okay. We'll
Motion carries.
we'll go back. We'll circle back to all that, I think. And let me get.
Which page are we on, Brendan?
It is, I'd like to be on page 18 of that
Got it.
short book.
Yeah.
I don't know if it will work, Dustin, but if you stop sharing, I can try to take over sharing and bring it up from my computer.
Is it not? Can you guys not see it right now? I shared it out. No. Okay.
I don't see anything. I just see a blank screen. Well, it's allowing me to hit share on the bottom. So let me.
Sure. Yeah. Go ahead.
It says it's disabled by the host.
Okay, I'm working on that.
Debbie, now we can see you.
Okay, wait.
Brendan, you should be able to share now.
Okay. Yes. All right. Can everybody see that?
Yeah.
Yes.
All right. Now I'm getting sort of some Adobe pop-up. Is that what you were getting, Dustin? He's asking me to sign into the Adobe Cloud.
No, I think that wasn't mine, but we don't see that on ours.
Okay. Well, all right. So hopefully you can see that the page 18. So this again is just another way of sort of comparing some of the risk measures. So what we're looking at on the left side is the standard deviation or the volatility. I describe this like the roller coaster. So the higher volatility you have, the higher standard deviation, the higher the peaks and the valleys in the performance. Sharpe ratio is in a kind of an efficiency measure or return per unit of risk. And then alpha is the risk adjusted return. So generally speaking, standard deviation, you want that to be lower. So of the funds that we're looking at, certainly Loomis, PIMCO, and Templeton have the lowest volatility. So that's obviously a positive there. In terms of Sharpe ratio, you want that to be a higher number. So Loomis as well as PIMCO kind of start to shine there. Their return per unit of risk is positive, where actually for Brandywine and Templeton is slightly negative over that 7 years. And then alpha, the risk adjusted return, kind of again, another way to look at some of that same information, but you see PIMCO kind of standing out a little bit there, 2.2 versus the Loomis at 0.97 and of course 0.15 for Templeton. Then it's the same information on the next page, just looking at the trailing 10 years. And again, generally speaking, the same themes. Where you've got Loomis and PIMCO tend to be the better performers in terms of those risk and return numbers. And then on the last page, a lot of that same information is also presented here. But what I also wanted to include a little bit is the up-down capture ratio. If you might recall when we were talking about JP Morgan, we spent some time, I call this sort of the measure of offense and defense. And so you get hopefully a little indication or of how they perform or when they would perform. So what you'll see here for Brandywine is they've got 114 and 141 on the downside. So when the market is up, they tend to be up more than the market, but when the market's down, they tend to be down more. Loomis is a bit more defensive. So when the market is up, they tend not to be up that full amount, but when the market is down, they tend to be down a lot less. Kind of the same story for PIMCO, but to a little bit better degree. So when the market's up, they get more of that up market, but not all of it. And then they get less of the down market. what looks really weird is Templeton. Actually, both of their numbers, at least on the 7-year, are negative. So when the market is up, they've actually been down. And then conversely, when the market is down, they've been up. And so they have these negative numbers. So it kind of speaks to that real contrarian sort of performance that they've had. Slightly more normalized over the 10-year basis, but certainly not as good. Obviously, generally the markets are positive more than they're negative. So having certainly a bit higher up capture ratio is more advantageous. But at the same time, having a lower down capture is always a positive. So when I see that, my eye naturally gets drawn to Loomis and PIMCO as the two options. I'll kind of pause there, see if there are any questions or comments before we.
I have a question, Brendan.
Sure.
Hey, how do we figure out these three? Because we did Brandywine last time, and it seemed like they were on the bottom of the three we chose. And it looks like out of this three, they're the exact same thing. And just looking at the numbers, I mean, they're nowhere near Loomis or the other PIMCO. And I get, it looks like one's PIMCO and Loomis, one's more majority of corporate, the other a majority of government. Why would we pick Brandywine at all, just based on the numbers? It looks like they're nowhere near it.
Yeah, I mean, certainly from the numbers, we would not suggest that amongst the three. I will say that, this particular, space doesn't have the same sort of breadth that a large cap domestic stock would, where you have literally hundreds and hundreds of funds. This is a relatively narrow universe. So, we still, it's a certain strategy, and it might be a fit for a certain client. It might be the right fit. But for your fund, it's probably not the best fit. But again, off a limited number of options, I wanted to at least be able to show you for comparison purposes.
Sure. Thank you.
But yeah, certainly given the numbers, again, my eye naturally goes to Loomis and PIMCO. But between those two, I tend to like, up and down capture ratios. I think that's somewhat telling. Obviously, the future or the past is no guarantee of the future, but certainly just the way they tend to do things. They certainly have a huge breadth and a lot of assets. I think naturally I would lean a little bit toward PIMCO. Again, both are very good funds, both very good firms, but they just seem to have a little bit better profile that I think probably you'd be comfortable with how they would perform and when they would perform. So again, that would be kind of my suggestion. But again, Loomis is also a very good portfolio. And again, this maintains the exposure. So it's not leaving, global bonds or ex-US fixed income. It would just be shifting that exposure to a different manager to still capture that exposure. Because again, given the low interest rate environment, we do view this diversification as a positive. Should enhance return compared to domestic fixed income, as well as provide that risk diversification, being having a little allocation outside the U.S.
Do you think that up-down capture ratio is for PIMCO is so much better just because of the number of holdings in that portfolio compared to the other options?
No, I don't think it's just because of the holdings. It's by how they have the portfolio positioned. And just to give you also, since we didn't get into this, they have a lot of positions, and they also, because of their size, they'll use some derivative securities and other things to create exposures without necessarily owning a particular bond, but they'll use derivative securities to get certain country exposure or currency exposure with those different vehicles. And they've been very good about, obviously over time building that portfolio and kind of being on the correct side and getting most of that up market while eliminating or reducing some of those down moves.
Brendan, on page 15, I see that over 10 years, PIMCO outproduced Loomis by 0.3%. On the other hand, their fee is 0.2% higher, so that makes it a little bit more of a wash.
Well, these are net of fee numbers.
Net
This
fees,
is
yeah.
after
Oh, okay.
you pay the higher fee.
Okay.
But yes, that is very true that it is a higher fee. But again, these numbers reflect that you've been paying a higher fee over that time.
Are there any other questions for Brendan? Do you guys feel like we have enough information to make a decision?
Real quick, Chris, I'm sorry, this is David Cohill.
Go ahead.
I couldn't get unmuted fast enough. Am I missing it, or I remember that there was a cost last time when we went to Vanguard and then made the switch over. Is there, or are there different costs with going with PIMCO versus Loomis?
You have the cost of the underlying fund, but there would be no fee to make the transaction. I think what we were talking about when we went from MD SAS into the Vanguard fund and then ultimately ended up with the JP Morgan fund. So with MD SAS, you had a separate account portfolio that had, and I forget the number, but let's just say it was 50 stocks in it. And when you sold those individual companies, you have a transaction fee associated with each one. So there is a cost to transition out of one portfolio and into another if you have a separate account or individual securities. But because this is a mutual fund, it would be there is no transaction cost or no fee to make the change. The only fee to consider is the fee of the old fund and the fee of the new fund. So the fee of the new fund is a little bit more expensive, but there is no charge to actually make the transaction.
Asked and answered. Thank you very much.
I'd like to go back to a comment that Jason made a couple of minutes ago, which I just have looked at, and it seems like a really good point. It's page 14, and you notice that Loomis is mostly, or it's investing more in corporations, and PIMCO has a lot more exposure to government. And I'm trying to wrap my head around who's more likely to do poorly in a continued weak global economy. And I'm not too sure, but I just thought I'd raise that again. Jason, what were your thoughts on it in noticing that?
Sorry to get unmuted. Sorry. Same kind of thing though. I mean, we're kind of at a, where are we looking at as far as rates going? Are they going up and down? And I think Brendan would have to answer that more than me because he's analyzing this a lot more than I am. But again, a volatile market, whether it's going to go up or down. I mean, corporate could very easily go up or down, and same with government. I mean, it seems like they're going to go opposite of each other, but I could be completely wrong.
Well, certainly that has been the case as of late. Whenever you have short-term, very volatile moves in the market, you tend to have a pretty big divergence between certainly something like corporates and government securities. But when things are relatively normal, they tend to track more closely. Although you will get a higher level of income typically from corporate or non-government bonds. You get a spread because you're taking a little more risk. Theoretically, a government can't go out of business. They can certainly run into problems, but a company can go bankrupt, and ultimately you potentially run into some issues there. So there is additional risk for being in non-government securities. But the real question is the manager selecting securities and getting a higher income or higher yield that compensates you for that extra risk? That's ultimately kind of how we measure and judge those managers. And can they navigate it? If you looked at these type of allocation numbers over time, they change, they move. There are times where they're more heavy in government versus corporate bonds and other things. And so they have to be nimble as they look at the markets and make projections going forward and what they see, and then obviously make allocation decisions. And that's again sort of what we're in part measuring, or what we have been with Templeton. They've been somewhat, they tend to make larger bets, whether it's in Ireland in the past or Argentina. They see dislocations in the market and they tend to go more heavily into certain places, and then it either pays off or it doesn't, but it has large swings in their performance. These other ones tend to be a bit more diversified in terms of how they're allocating, but again, they're including more corporate exposure. across the board certainly than is Templeton.
Hey, Brendan, instead of looking at as far as government versus corporate bonds, I think a better way to look at it is the quality of the bonds itself. So why is the PIMCO, you have an NA as far as the average credit quality over there?
I think because of their kind of derivative exposure and the way they have it, they really, you're not getting that same credit number that you would if you're owning the individual security. It is still kind of considered a high quality or a higher quality portfolio, but because of their sheer number of securities and the derivatives don't have, a double A or a single A rating on them. So it winds up kind of not populating.
Makes sense, I guess. And then is there any concern? So PIMCO is a lot more diversified in theory than the other two, because there's 1,755 holdings, but 40% is in the top 10 as opposed to the other two that are 27 and 34%.
Yeah, they do have a little more concentration when it comes to that aspect, certainly. Again, it sort of comes back to, how good are they at sort of anticipating what the market's going to do, or positioning themselves to have a proper, kind of risk and return profile. They've been pretty consistent at doing that, but certainly having a larger weight in that top 10 is a risk. That's how you will tend to outperform. If you're correct, having those weights works, but of course, if you're incorrect, if you're on the wrong side, that certainly has a negative
The negative cash asset allocation, does that mean they borrowed the equivalent of 60% of their borrowed money equal to 60% of their portfolio?
It gets a little wonky, and that's the derivative securities. It's not that they're leveraging the fund like that, but the use of derivative securities throws that off for sure.
Well, as a non-finance guy, when I hear derivatives, I think of the late 2000s financial debacle.
Yeah, there's certainly, yes, there were derivative securities back then. These are a little different, the like kind of currency positions, but not derivative securities that are based on phantom assets or worthless assets. That's one of the issues with PIMCO having quite the money that they do. When they want to build an exposure, if it was in a particular country that's not huge, they have so many dollars that they would dramatically affect the price if they were buying that government holding or a relatively small corporation. So what they often do is use some derivative securities to get the exposure of being in that asset without actually having to own the entire country, so to speak, or a significant portion of it, which would affect pricing. That's one of the things, if you've ever heard us talk about, small cap managers, you won't find a small cap equity manager that has $2 trillion in it. Because if they had a huge portfolio, they would have to own all of the companies. Like they have to own 100% of these small cap companies in order to build the position to put that money to work. So so it's a little bit of that. PIMCO being so large that in some of these certainly smaller countries or smaller companies, they can't, put whatever that number is, $500 million, they have to build exposure through some of those derivative securities where Loomis and some of the other managers that don't have near the assets, they can go ahead and just build the position in the actual security because they're relatively small compared to PIMCO.
Okay, some good questions asked. Is anybody leaning one way or the other at this point?
Personally, I'm leaning through PIMCO. They cost more, but they're worth the extra money.
Sarah, anybody disagree with that? Anybody want to fight for a Loomis?
No, I think this is Dupree. I think in his recommendation summary, it sounds like he's leaning toward PIMCO. Brandon, I mean.
It is, again, both are good funds, but just generally, I think the risk and return profile, your plan, your board is relatively risk averse. And I think the PIMCO fund just matches up a little better with that. But again, not to say that Loomis is a bad choice. I just, my thought, the way the PIMCO fund tends to perform, it just matches up from a risk standpoint with your plan.
Anybody not ready to call for a motion? All right. Anybody want to fight for Templeton?
One more quick question for Brendan before you go to a vote. Any concerns with leadership on either of the companies? Any big people leaving or anything like that anytime soon that you know of?
Not that I know of. That's an interesting point. PIMCO did have that a number of years ago with Bill Gross, and that caused a lot of disruption, but they've been pretty stable more recently. And in addition to that, I think they've used that exercise as an opportunity to kind of make sure they built out their teams with a few more people to not be so top heavy, so to speak, where if one person leaves, it's incredibly disruptive. So again, certainly something could change tomorrow that I'm not aware of, but at this point, no, we're not anticipating any issues.
Anybody else? Okay, we're going to start at the back from how I normally start. With the firefighters, I'd like to see a motion that we transfer investments from the Templeton Global Bond Fund, the current Global Fixed Income Manager, to PIMCO Diversified Income. Can I get a motion from the firefighter board?
So moved. Candler.
A motion from Candler. Is there a second?
Second,
I'll
Pawlowski.
Second, Pawlowski. Sorry, Debbie.
That's all right.
Any discussion? Roll call vote, please.
Gaylord Candler,
Yes.
Dennis Pavlovsky,
Yes.
Debbie White,
Yes.
And from the police board, the same motion that I already read.
Motion Cohill.
Second, Dupree.
Any discussion? Roll call.
David Cohill,
Yes.
Marvin Dupree,
Yes.
John Gostilla,
He was definitely here earlier.
he was.
Is that everybody? Sorry.
Jason Sharp,
Yes.
Okay. And general employees, same motion.
Make a motion to approve.
Motion from Dumont.
Second, Brandon.
Thank you, Brandon. Any discussion? Roll call.
Nick Curry,
Yes.
Georgette Dumont,
Yes.
Chris Hoffman,
Yes.
Brandon Maresma,
Yes.
Eddie Vergara.
Yes.
Okay, motion carries. So we're going to move out of Templeton and into PIMCO. And I would just like to thank Brendan for that presentation, and also all of you for doing your homework and asking some really good questions. So I think it makes it a lot, the decision making is a lot better when we're really fully vetting these options. So I appreciate you guys all doing that. And then, okay, so now on to Dustin, pension administrator report.
So, all right. So you stopped sharing. I'm going to try and share out my screen now. Where is the... Okay, can everyone see that?
Yes,
Okay.
I can.
All right. All right. Well, instead of just reading through the numbers here, I'd kind of like to go over to my report, and then I'll circle back to some of as we get further down the discussion. I know it's kind of small when you're looking the way we're looking at it right now, but in the general employees, the number of vested members that we have, if you can see my mouse there, it's moved from 95 to 87 over the last 3 quarters. And in general, over the last couple of years, that vested number has been dropping. So I kind of just been noticing that, and I started looking into why that was. And what I realized was in 2008 we had the financial crisis and all that, and since we had 10-year vesting, there was kind of a hiring freeze and at least a slowdown in hiring back at that time. So for 3 years we didn't do a whole lot of hiring. And we're kind of seeing that now because people are still leaving. So your vested numbers are retiring, or maybe they are pulling their money out. Even somebody that was vested, we've had a few of those. So you've got some people that where that number is dropping, but people that are becoming vested aren't being added. So there aren't people that are becoming vested because there was nobody hired in the previous 10 years time frame there. Now that doesn't really ring true for the police department. I wasn't here at that time, so I'm not sure if that hiring freeze really applied to the police department, given your first responder kind of status. So just kind of wanted to point that out as one of the more I guess an odd number that kind of jumped off the page there. Everything else is pretty consistent. Retirees receiving benefits at 193. We've got kind of a long list this year of refunds and rollovers, longer than in years past. I don't think there's any particular reason for that. It's just kind of coincidental. I know we did have several people in the electric department that went to other electric departments, and that's some of the refunds and rollovers you see there. That's maybe the one odd thing that's happened. Circling back over here, again, no conferences that we have scheduled right now. We do have some offerings of some virtual experience from FPPTA. Again, if you're interested in that, I'll be happy to forward that information to you, and we can get you set up with that. Otherwise, I will keep you informed when we start having conferences again. The Form 1, that is the required disclosure. I'm not sure. I don't think Lori's in the room. I have been in contact with Lori. I know that she's been in contact with those that didn't get the Form 1. I think there was just one or two that maybe didn't get the Form 1 in by that July 1st date. But if you haven't heard from Lori, then you should be in good shape there.
Dustin, can I add in for that one? It's Jody.
Yes, absolutely.
And the two gentlemen that have not turned in are not with us online. It's John Galarno and John McDaniel. And Debbie, if I'm correct, moved out of Duval County.
Yes.
So you'd still, I believe you'd have to file with the county that you're in. But other than that, that's it.
Let's discuss that with Dustin.
Yeah, she sent that to us, and then we got that where it needed to go.
Okay, and those are the only three for the pension board.
And then coming up here, I think Eddie's going to be recruiting people to, for posters and stuff like that to be hanging in the hallways for his employee election that's going to be coming up here, probably next month. And, that'll be going through the city clerk's office. So we'll be on the lookout for that. And then the next quarterly meeting will be November 10th, Tuesday, back kind of on our regular schedule of a Tuesday at 3 p.m. And in that meeting, I will have the list for the upcoming next year's meeting, all four meetings for 2021. Also at the next meeting, we will have a proposal and a recommendation for the software, the pension software that we've been looking at. We've got a couple of different providers that we have been talking to, and they're getting some demos together and things like that. We're just kind of trying to vet them out and see which ones we think would work best in our particular situation, and then we'll bring that to you next meeting. And I think that's about it for me. Any questions or anything?
I just had a comment. This entire meeting, I've been trying to figure out what you sound like, and it is definitely an airline pilot.
See, everybody says that because of that.
It's
We had a meeting the other day, and they were.
It's not
they were
even
trying
what
to
you
get me
look like, but even the tone of your voice is like, and we'll be hitting rough weather. I mean, and Eddie, if you need any puffy paint or glitter for those campaign signs, let me know. Does anybody?
Yeah.
I got Ann with that one. Anybody have any other comments for the group? Okay, and are we assuming Zoom in November? Did you see, or just stay tuned?
Well, yeah, stay tuned for that. It's not been approved by the governor yet out that far, but we'll keep you posted on that.
So just look alive on that one. And if nobody has anything else, we are adjourned. I don't think we do a motion for adjourning, do we?
Oh, wait. Do we need to go back and do the fire board's approvals of the minutes and those items?
Good call. Jody, do we need to do that?
Well, when Debbie logged back on, she said that she approved the
Okay.
report and presentation, but
And the minutes.
in the minutes, yeah. No, I think we're good.
Okay.
Works for me. Maybe not for Robert's rules, but we'll follow it. Okay. Anything else? Okay, we're adjourned. Thank you, guys.
Thank
Take
you,
care, everybody. Stay safe.
Fun as always.
Goodbye.